We're coming around to the end of the year, and before the year ends, here are four tax strategies that could lower your 2025 bill. Stay tuned all the way through. We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in. Thanks for tuning in to the Secure Your Retirement podcast. I've got a great episode for you today. I say normally I'm joined by Raiden or Nick Hymanson or Taylor Wolverton, but today we are knee deep in meetings when it comes to tax strategy. And so I'm going to be relaying some of the information today as far as what tax strategy means and more specifically, what are some tax moves that you could be making to lower your 2025 tax bill. To set the stage here a little bit, I want to explain what the difference between tax filing and tax strategy is. A lot of times we say we've got a CPA that helps us with taxes, where in reality, if you think about what that relationship is for most people, is we get around to say February of the following year, and our documents start coming in the mail, 1099s, W-2s, other tax documents, and we gather those up and we get them over to the CPA. And then the CPA has a little bit of back and forth with you, more verifying the information, and then they put together the tax return, send it over to you for your review and for your signature. You may make a payment, you may expect a refund, and then there you go, taxes are filed. And that's what most people have a relationship with when it comes to a CPA. In fact, I was on a phone call earlier today with someone who said, and they attended one of our events and we talk about tax strategy. And he said, my CPA doesn't do any of what you guys talk about. They do exactly what I just described, which is get the documents, prepare the return, file the return. No advice given. And we set out years ago to change what tax strategy really means to us and to our clients. And so what that has really developed into is a very in-depth look into your taxation. And the key here is that we do this whole process, this whole exercise prior to the calendar year flipping over. So, we don't wait till April of the following year when your taxes are due. We want to have these conversations before December 31st. Why before December 31st? Well, a lot of tax strategy has to be implemented before the end of the year, not by tax filing time, but by the end of the calendar year. And that's often a misstep that we want to avoid because there's a lot of opportunity on the table, especially given here recently with the passing and the extension of our tax rates with the One Big Beautiful Bill Act that we've talked about here on the podcast. The opportunity continues. Now, however you feel about that bill itself, it's been controversial to a degree. The fact of the matter is it's here. So let's take advantage of the tools that come with that bill itself. Some of these are just as simple as understanding that the rates are staying a little bit lower for longer than expected, because in reality, in 2026, we were supposed to see tax rates start to go up a little bit. That's not happening anymore. So let's take advantage of it. So what do I mean by tax moves to lower your 2025 bill? So what Taylor, and you've heard of Taylor Wolverton on our team, she's a certified financial planner as well as an enrolled agent. Enrolled agent is recognized by the IRS as someone who understands personal and business tax. And so what she does, and she leads our tax team and tax strategy, is we'll meet with clients and understand what their prior year tax returns have looked like, to get an idea of what their tax scenarios are. And then she'll build out here we sit in 2025, so a 2025 tax projection to say, hey, if everything goes the way we think it should go from an income perspective, capital gains perspective, all these different things that can play with your taxes, if everything goes the way it should, here's a projection as far as what you're going to owe or not owe come April of next year. So just making a bottom line type of projection. What that allows for now is the entrance of tax strategy by saying, hey, if we make these tweaks or do these types of transactions or move our withholdings up or down, it will make our tax life a little bit simpler or better for short-term planning as well as for long-term planning. And I'll explain what that means here in a little bit. And And so she starts to make projections based off of opportunities that are seen, whether it's different types of investment strategies or different types of charitable giving strategies that I'll talk a little bit more about here in a minute. Um, and what the feedback has been in these tax strategy meetings from the clients has been, I've never looked at taxes this way before. I've always been that person that was, hey, just get it filed, and whatever I owe, I owe. It's out of my control. And they walk out of these meetings, one, understanding our tax code a whole lot better, because Taylor will take the time to educate you on how the different parts of the tax return work and operate together. And then the other is they start to see and learn and understand a lot of the missed opportunities that have been happening over the years, and start to understand the value in having these tax conversations that a CPA is not typically willing to have with you. One, a CPA is a very high transaction type of business. Where they make their money is by filing the tax return. They don't necessarily have time to come up with strategy for every single person, because when it's tax time, they are filing hundreds, if not thousands, of tax returns in a short period of time. So that is what they need to be focused on. Well, in our world, in the wealth management space and financial planning and retirement planning, we are very relationship based. We want to know our clients, understand our clients, and do everything we can to make their life a little bit better when it comes to risk, income, planning, tax strategy, estate plan, and everything that is required for a quality retirement life. And so we're able to spend a little bit more time. We're able to have the expertise and bring in the specialists that understand whatever we're looking at, so that we can now start to develop and make these plans a little bit better over time. So, with that setup, let me walk you into a handful of different things that are coming out of our tax strategy meetings. Taylor's actually in tax strategy meetings all day today, along with our wealth advisors, whether it be Nick Hymanson or Ben Burgess. And but we asked her to put together what are the most common things that she's seeing when it comes to end of year tax planning for our clients. Now, I believe it's a 70 plus point checklist that Taylor looks through as far as different types of opportunities and her evaluation of the tax return. But at the end of the year, it really boils down to four major ones that we're utilizing for our clients. And so I want to give you a little bit of insight as to what those are today. The first one I'll talk about is what's called a qualified charitable distribution. Now, I'm not going to have enough time today to walk you through exactly what that is, but I'm going to explain why it's important to understand and look at. So, first thing, it is a charitable contribution. So we're giving money away. So if you are charitably inclined, this may be of interest to you. Uh, Today, with our tax situation, um, there's not a ton of benefit given to charitable giving, because a lot of people are taking the standard deduction. Years ago, the standard deduction got increased so high that it made it almost impossible to itemize your deductions. And so most people today are taking the standard deduction. Well, what that doesn't allow for is getting true benefit of the charitable contributions that you make throughout the year. So if you are charitably inclined, and here's the other caveat, if you are of the age of 70 and a half and above, if you're not there yet, then just make note of this strategy, especially if you're charitably inclined, because you will want to utilize it down the road. So if you're charitably inclined and of the age of 70 and a half, and also have, let's just call it IRA type assets, pre-tax type assets, then this could be a strategy for you. What this really is basically we're donating dollars out of our IRA, which in most cases we would pay tax on. So let's just go with an example. If I was to take out $10,000 from my IRA, that's adding $10,000 to my income for the year that I'm going to pay tax on. Well, if I'm doing it specifically through a QCD, that's the abbreviation for Qualified Charitable Distribution. If I'm doing it specifically through that mechanism, well, then I avoid adding that $10,000 to my tax for the year. $10,000 of additional income goes away for the year. Well, how is that possible? It's all part of the tax code and understanding the tax law and how IRAs work. So if you're of the age of 70 and a half and above, and you typically give to a charity throughout the year, whether it's a church or an organization that you believe in, as long as it's one of those recognized 501(c)(3)s, then you're eligible to make a qualified charitable distribution. So that $10,000 donation that you would normally make out of the bank and get no tax benefit from in most cases, now we can take it from our IRA. It comes out, no taxes on it, and it goes directly to the institution as your donation. So two things happen here. One, you get to give the way that you want to give. And two, we get a tax benefit. We just pulled from our IRA tax free. It is almost impossible to do that, except for really in this type of strategy. Um, so that's one to think about. Now, there's some nuances, there's some nitty gritty, there's some logistics that you need to do right. Bottom line, this has to be fully completed. When I say fully completed, the dollars have to be in the charitable organization's hands before the end of the year. So you don't want to do this on December 25th because you're not going to get the money to them in time. You really want to start this process throughout the year. But November, we're getting tight as far as getting this accomplished. So that's tax strategy number one that you can do by the end of the year. The second one is still along the lines of charitable giving. And let's say you said, hey, I'm not 70 and a half yet. What can I do to help my taxation because I am charitably inclined? Well, there's this thing called a donor advised fund. We've done a whole separate podcast episode on this as well. But go back to that conversation of how most people today are utilizing what's called this standard deduction. It's somewhere in the low 30,000s this year. So the first $30,000 of income that you have, you do not pay any tax on it. It comes right off. And so because of that standard deduction, a lot of people are not in a place where they can itemize deductions because of the standard deduction being so rich. Well, if we are someone that is charitably inclined, and let's go back to that person that gives $10,000 a year and they're under the age of 70 and a half, they can now create what's called a donor advised fund. A donor advised fund is an account held at an institution like a Charles Schwab. And basically what we do is we shift money into this account. It could be cash, or even better, it could be highly appreciated stock like an Apple that you bought 20 years ago that has grown considerably and has a lot of capital gains associated with it. So back to that example of $10,000 is your usual giving for the year. Well, what if we said, hey, for this year of 2025 and for next year 2026, let's go ahead and make that $10,000 donation for this year and for next year, so $20,000 together. Let's go ahead and put it into that donor advised fund here before the end of the year. What that's going to do is give us now a $20,000 charitable contribution or a deduction that can now throw us into a place where we can itemize, and all those other expenses that you have can now be utilized in the itemization of your tax return. So that can be pretty valuable to someone who is charitably inclined. You get to name the fund. I think that's always fun. You can name it your family donation fund or your family whatever you want to call it, basically. But that makes it nice and fun. Now the dollars that go into there, you cannot get them back out. And they need to be given out, but there's a ton of flexibility there. So it's kind of like operating a bill pay. You have checks that are sent out to various organizations. So there's a ton of flexibility, and all we're doing here is funding some donations up front so that we can get ourselves into a place of itemized deduction that helps our tax bill even better. I want to go back real quick to the qualified charitable distribution. I forgot one major key part of this, which is, so you're eligible at age 70 and a half. However, when we hit age 73 or 75, or you may already be in it, it's called required minimum distributions. That's the forced withdrawal on your IRA assets when you hit that certain age. What's nice about the qualified charitable distribution is it applies towards your required minimum distribution. For example, let's say your required minimum distribution is $20,000 for this year. You give 10 of that away to charities through a qualified distribution. That counts towards the 20 you were supposed to take for the year. So you give 10 away, you'd have to take the 10 remaining for yourself. That means you only pay tax on the 10,000 required minimum distribution versus the 20,000 you would be forced to take because you gave 10 away as a qualified charitable distribution. So another really nice piece about the QCD if we're using it properly. Okay, so QCDs, donor advised funds, also abbreviated as DAFs. Another strategy that where it's more of implementing is a tax-efficient portfolio management. We call this direct indexing with tax loss harvesting. In a nutshell, this strategy allows us to mimic an index, think the S&P 500, but not buying an ETF, which is what most people do, or buying a mutual fund today, which is what most people do. Instead, we're going to mimic the index by buying a bucket of those stocks. It's usually about 50 to 75 of those stocks. And you may say, well, why would I buy those when I can just buy one? Well, if I buy one, the ETF that is the S&P index, and if the index goes up 20%, my ETF just went up 20%. Fantastic. But I'm sitting in a non-qualified account or a brokerage account that's subject to capital gains, interest, and dividends. And so now I'm kind of stuck with this ETF because I don't want to sell it because that's going to cost me in taxes. So what can I do differently? Well, the goal here is we get the return of the index. How the indexes work today, most are the return is driven by really the top 15 to 20 stocks in the ETF in the index itself. And in fact, some of the indexes, the top 5 to 7, we've heard of the Magnificent Seven stocks kind of carrying the markets really since the pandemic in 2020, and that story is still pretty true. So we don't have to have all 500 stocks of the S&P 500 to get the return of the S&P 500. We can mimic the index itself and the movement of the index with just 50 to 75 stocks. Okay, so that explains why we need to buy 50 to 75 so that we can mimic the movements of the index itself without having to buy 500. Where's the tax piece come into play? Well, now if we have 50 to 75 stocks, the question I would ask to you is, do all stocks go up at the same time? Hopefully in your head you're saying no, and which is true. Sometimes some stocks go up, some stocks go down. What it gives us is a playground, and I use that word lightly. We're not playing. This is all technical data driven types of investing strategies. But in all essence, it gives us a playground to sell some of those losers while the winners are winning and taking our performance up. But now we get to bank losses for our taxes. What this allows for is, at the very least, offsetting some capital gains and some types of tax situations that come out of this brokerage or non-qualified type of account. And then in the perfect world, we also get to use some of those losses towards our tax return to go against our ordinary income for a few about up to $6,000, which can be very, very helpful on your tax return itself. So direct indexing with tax loss harvesting, while it sounds big, it is a very neat strategy. If you have non-qualified dollars and that you feel are not tax efficient, and you keep getting surprised by the 1099 that comes to you in February every year on that account, this may be something to look into. All right, the last one, and this is the biggest one that you need to be doing by the end of the year if it makes sense for your plan. All of these are all strategies that, with the caveat of if they make sense for your plan, is the big one, which is Roth conversions. So let me do this. Let me kind of walk you through some numbers, because I asked Taylor to give me some examples, some real life examples of the tax savings that she's seeing by utilizing some of these strategies. And so I've got two for you on the qualified charitable distribution. So we had one client reduce their RMD taxation while giving to their church. So they had the RMD they had to take. They gave some of that RMD to the church completely tax-free, and they took the remainder RMD for themselves. What that resulted in on their tax return was a savings of tax dollars that they had to pay. It saved them about almost $3,700 in tax they would have had to pay. This is no product. This is really just understanding strategy and the tax code and having a team that can help you see what's best for you. Another family, utilizing QCDs, they were able to lower their taxable income and avoid Medicare surcharges, which is a massive pain point for anyone that's ever experienced them. It's a surcharge, or you could call it a tax on your Medicare premiums, Part B and Part D, if your income is too high. So what this family was able to do is reduce their income below Medicare surcharges by giving away some dollars. What that resulted in is a tax savings of about $4,300 for this year. So those are just two smaller examples, or examples in general, of how qualified charitable distributions can affect your bottom line. And when it comes to charitable giving, if you're giving, that's great if you feel like you should give, but also I feel like we should take advantage of what tax benefits are there for us. Okay, on donor advised fund, here's a couple examples. We had one family that turned charitable giving into a tax deduction. So they did the bunching, like I talked about, that example of 10,000 for this year, 10,000 for next year. We're going to bunch it together into one year, 20,000 going into a fund. I don't know their specific numbers, but the bottom line, it saved them $14,000 in tax by doing what they were going to do anyway. They were going to give 10,000 in this year and they were going to give 10,000 next year, but they were going to do it in individual tax years. So they were going to give 20 over the next 2 years either way. What we did was find a way so that we could make it tax advantage and save them a little bit more money on their taxes. It saved them $1,400. We have another example of someone that gives a little bit more and they wanted to accelerate their gifting. And so they did more bunching into the donor advised fund. It saved them $4,600 in taxes paid this year, or in taxes paid for this year. And the last one that I'll speak to is the tax efficient portfolio, direct indexing with tax loss harvesting. If we took a $1 million account to be tax efficient, so rather than just buying a handful of different stocks and eventually those stocks or funds or ETFs getting to a place where we feel handcuffed to them because they've got such good gains in them, we don't want to sell them because of the taxation. So we manage this a little bit more tax efficient with those bucket of stocks to represent the index. So we get the index growth, positive or negative. We're mimicking the index, but we get tax efficiency along the way. What that really means is what we've seen is that you generate tax alpha. Alpha means we're getting better performance because we're paying less in taxes along the way. We generate about 1% tax alpha in this type of strategy. So if the index made 10, well, because of the efficiencies here and avoiding some capital gains tax, which can reduce your return, the tax alpha generated makes the total return closer to 11. Index made 10, we have tax savings about 1%. So it helps us in the long run, helps our money stay in our pocket versus giving it to the government. Okay, the last one I'll talk about, and this is a big conversation, is Roth conversions. These need to be done by the end of the year as well. 12/31 is when they have to be done. Don't confuse these with Roth contributions or IRA contributions. That's really the only good or decent tax strategy that's left for you come April, is you can put money into your IRAs even after the calendar year has flipped if you qualify for that tax benefit. What I'm talking about here is a Roth conversion. That is taking money from your pre-tax IRA type accounts and deciding and making the decision to pay some tax so that we can get it into a tax-free bucket called a Roth. So who makes decisions to voluntarily pay tax? Well, not many would do so. And I'm sitting here talking about reducing tax, and now this strategy is going to increase my tax for the year. Well, if we understand the big picture and the why, then it could make a lot of sense. I think today where we sit, our tax rates are in a lower place. Could they go lower from here? Anything is possible, but I think most would say it can only go up from here, given the issues that we've got with the national debt and everything else going around us. It can only go up from here. Like I said at the beginning of the podcast, though, we did get a bit of a break here with the One Big Beautiful Bill Act, and the tax rates are staying consistent for longer and not going up yet. Technically, they're permanent. We'll see what permanent means in the coming years. So Roth conversion planning is a long-term tax strategy to reduce our taxes paid over our lifetime, and then if we have desires for legacy, to reduce the tax inheritance potential issue that they may have down the road. It's as simple as this. Is it way better to inherit tax-free money, or is it way better to inherit money that no taxes have been paid on whatsoever? Well, there's no magic here. Someone does have to pay the tax, and that's done through a Roth conversion. So we had a family come to us, and this is one of Taylor's examples of how she navigated a Roth conversion conversation with a family of ours. And basically, they came in with the concern that a lot of our clients feel, is that they're worried about tax rates going up. They're worried about their future required minimum distributions getting astronomical, or they're worried about leaving behind too much money to their legacy that is going to cause tax issues for them. And so what they wanted to do is start smoothing out their taxes and start doing some conversions in a responsible manner so that we avoid Medicare IRMA surcharges. Again, that's if you make too much income or create too much income then you may be thrown into a penalty zone with Medicare Parts D and D that can cost quite a bit and be quite a bit of a pain. So what Taylor and the tax team came up with is we're going to convert into the 22% bracket without triggering any Medicare surcharges. And what we're going to do for this year here in 2025, the numbers made sense based off of the analysis to convert up to the 22 or into the 22% bracket. This family was able to say, let's take $66,000 from our IRA. Let's add that to our taxable income for the year, which means we're going to pay tax on it, so that we can get that 66 into their Roth account completely taxed, so that it can grow tax free. By the way, we're not doing this for 1 year. Where this plan, the numbers, the projections, the way it works is for this family, we're going to do this from 2025 all the way through 2033. I'll put an asterisk here. No plan that we ever make is set in stone. And so this tax plan is going to be reevaluated every single year in their annual tax strategy meeting with the team, because we know very well that life changes, and especially tax law can change on us. And those are things that we want to make sure that we're paying attention to year over year. So this is just a preliminary type of deal that, hey, if everything works out and nothing changes from here, we could be doing this for the next 8 years. Here's the big number. So on the QCDs, on the donor advised fund, on the, on those are immediate tax savings, but they're relatively small. Everything is good, but every number I gave you is kind of in that $1,000 to $5,000 of tax savings, which is substantial. You don't want to forget about it, and you don't want to ignore it. But when we do long-term tax planning and realizing that our investments grow over time, and if we have an IRA that was $1 million when we retired and it grew to $1.5 million, it grew to $2 million, those are all dollars that have not been taxes paid yet. So our tax burden continues to grow on those accounts as they grow. And so where the big tax savings, the big dollars, the really long-term nice planning comes into play is something with these Roth conversion plans. So if this family does it from 2025 to 2033, and our tax rates don't go up, we're just projecting, hey, what if tax rates stay the same? Their tax savings lifetime is going to be about $320,000. It's going to save them from paying about $320,000 in taxes over their lifetime if they live to age 90 and 87. They're 65 in this story. So to me, that is big tax dollar savings. Not only did they save it during their lifetime, but also we've gotten substantial assets into the Roth account for their next generation to inherit with much less stress and pain when it comes to taxes. So I wanted to walk you through these elements as far as the 4 tax moves to lower your 2025 tax bill. And here's what I would say. If you have an advisor, I'm sure they're talking to you about this stuff, but if they're not, they may not be equipped for it because it takes a team. It takes an infrastructure. And if they're not having the conversation with you, I would ask them why. Or if you'd like to have that conversation with us as far as what does tax strategy look like for you, we are always happy to hop on the phone. Easiest way to do so is to go to our website, pomwealth.net. And from there, you'll be able to schedule a consultation. It's usually a 15-minute phone call or a Zoom call. We're happy to see you in our office as well. We do a lot of educational types of events. We're happy to get you to one of those. So if you have interest in having a team in place that not only helps you with the investment side, but everything when it comes to financial planning, when it comes to income planning, tax strategy, estate, healthcare, then that is exactly what we do. And that's what we have strived to bring to our clients as we built out this thing called the Peace of Mind Pathway. So if this is of interest to you, we're happy to have that conversation. But until then, thank you for tuning in. I hope you enjoy your day.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.